Welcome, ladies and gentlemen, to PMSIF World's the latest webinar call in the Invest N series. We have been doing these webinars since a year now, and you can find all of the repository at YouTube. Please give us a like and a thumbs up so that more people get to know about our webinars and our good work. And in that spirit, we have a very special guest, Mr. Navin Agarwal, CEO and MD of Motilal Oswal Asset Management. And you've been watching this series. I am Sankalpo. I represent the business development team at PMSIF World. And let me tell you this about Navin. Navin is a research analyst at heart, and I am a relationship manager at heart. So it makes for a very interesting combination. And I'm sure today we will take a lot of questions, a lot of answers from Navin on what actual investors are looking at. And Navin has his ears on the ground, so he interacts with investors on a daily basis. So he'll give us very decent, very unique and very to the point perspective. A little bit brief introduction about Navin. He's been with Motilal Oswal for the last 21 years, right, Navin?
That's correct.
So since 2000, he's been with Motilal Oswal. Right now, he heads Motilal Oswal Asset Management as its CEO and MD. Earlier he has been responsible for scaling up and developing a lot of Motilal Oswal's businesses. So we have a businessman and a research analyst together. That's a lot of unique perspective to come from. And at that, he has been phenomenally successful as an investor, as an analyst. And today he has the charge of an asset management company, which has its unique style called QGLP, managing close to $5 billion. So welcome, Navin, to the show. And I'm hoping for a very interesting discussion. I'll just get on to the session today by giving out the answers for the polls that we held. So the question that was asked was, I'm worried about a 30% market correction in the next 3 to 6 months. Okay, 42% said yes, 57% feel that the markets won't correct by that extent. So that is just context of how bullish things are right now. And Navin, before I ask you to present, I will talk about a recent note that you released. Okay, it talks about the uncanny resemblance of the bull run that happened almost 15 years ago, from 2004 to 2008. And the timing couldn't have been any more ironic. It was exact this weekend when Lehman Brothers collapsed in 2008 on 15th of September. It was an anticlimax ending to a stellar bull run. Okay, so in the note, you have listed a lot of similarities, a multi-year kind of a bull run that happened then, and what could probably happen now. Okay, so my question to you is, how are you looking at these two similarities from an investor's or a stock picker's approach? Okay, what will you look at as an opportunity, and what would you probably be a little bit cautious of or wary of? Before we start with your presentation, please let's take this and start the show.
Absolutely. Thank you, Sankalp, for having me, and thank you for the question. So basically, in the note, what we try to highlight is that history may not repeat itself, but it surely does rhyme. And if you see, there are so many similarities between Jan 2002 and Jan 2020 that I was really provoked to write this article and bring to investors through exhibits that I put out in that article that I'd recommend you to consider reading. It's available on our website, which you can, on Motilal Oswal Asset Management website, which you can download and read. So basically, if you go back in time, in the year March 2001, 2, and 3, those 3 years, the compounded annual GDP growth fell down to the Hindu rate of growth of just about 4%. And then after those 3 years of consolidation in economic growth, we had between 8 and 10% growth in the year ending March 2004, 5, 6, 7, and 8, and even in quite a few years after that. And if you look at the year ending March 2020, which is even before COVID pandemic, and the year ending March 2021 and 22, right? The year 20, we had GST disruptions pre-COVID. The March month had already had its toll in the month of March 2020. The year 21 went in battling COVID and the lockdowns and its huge impact across the globe and including in India. And then the year March 22 is the vaccination year, when we are gradually trying to open up. And guess what? During these 3 years, our economic growth is likely to be a compounded 2.5%, even worse than the base of 2001, 2, and 3 that you saw. But what you must not forget is that in the last half a decade, a whole bunch of structural reforms have been undertaken. We have the landmark GST reform, we have the RERA reform, we have the IBC reform, we have the land reforms, we have the labor reforms. A whole bunch of things have been done. And so many surgeries have been performed in this body called the Indian economy that I believe that we are far fitter, far stronger to be able to run much harder going forward. So I think the backdrop is very similar of very poor economic growth. Second, poor economic growth brings with it a very poor savings and investment rate. And if you go back in time, we had seen a bottoming out of our savings and investment rate in the year ending March 2002. And from there, we saw a huge pickup of almost 8 to 10% in both our savings and investment rate. Once again, poor economic growth in the last 2-3 years has driven our savings and investment rate down to decadal lows once again. And we expect that as this economy, which is fitter and stronger, bounces back, you will see a bounce back in the savings and the investment rate as well. Third, we believe stocks are slaves of earnings. When earnings do well, stocks do very well. And when earnings do badly, stocks do even worse. And if you go back in time, in the year ending March 2002, our corporate profit to GDP had fallen down to 2%, which into 2008 rose to nearly 8% corporate profit to GDP. And guess what happened in March 2021? Our corporate profit to GDP was back to square one. We were at 2% corporate profit to GDP because a whole bunch of corporate profit pools, sector after sector, got destroyed. So if you see, telecom sector was making losses, commodity sector was making no profits, capital goods sector was not getting anywhere, pharma sector was impacted by US FDA issues, and I can go on and on. Auto sector was impacted badly. So we've had half a dozen sectors where corporate profits really vanished. And that is why the heavy lifting of corporate profits was done by a handful of sectors like IT, private sector banks, technology, consumer sector, and so on. And those were the ones which are doing well also. We believe that corporate profit to GDP is set to go back to anywhere between 5 and 6% over the next half a decade, which will imply a corporate profit growth of more than 20%. And let me remind you, in the cycle of 2002 to 2008, when you had miss and cut making way for beat and upgrade, that was also accompanied by a gift of bull market called re-rating. Typically, you see derating of the markets like you saw from 2009 to 2020, when Nifty performed lower than the Nifty earnings growth. On the other hand, between 2002 and 2008, when Nifty earnings grew by 25%, you got a gift of 12% per annum, and markets compounded at 37% per annum. Right? So that's the fourth important thing to keep in mind. The fifth thing to keep in mind is that we saw a nearly 4x in our forex reserves back then. And many may not remember, but rupee was rock steady at around 45 levels from 2002 to 2008. We believe that with $600 billion plus forex reserves, with the IT sector likely to grow at double digits, and with commodity prices likely to remain, or energy prices in particular, likely to remain stable at in the range of $70 odd, we believe that India's forex reserves could scale up to $1 trillion, making it one of the top forex reserves in the world in this cycle. Right. And I'm not even talking about potential inclusion of India in the bond indices possibly in the next year. Leave that aside and the forex flows aside, but even just the strength of the IT sector, just the weakness of the long-term oil outlook itself, and the impact of production-linked incentive, where huge imports will get substituted for domestic manufacturing, augurs really well for our foreign exchange reserves. That in turn augurs very well for our currency. And I believe that next 5 years, you may see currency stable at around 75 levels, give and take $5. Like you saw stable currency back in 2000 to 2008. And what does stable currency do to the stock markets? What stable currency does to the stock markets, particularly of emerging markets, is that it catalyzes foreign flows. Rupee depreciation acts like a tax to foreign investors. And at a time when corporate earnings growth are weak, they have no incentive to invest. At this point in time, you have two things going India's way. We expect India's corporate profits to grow at 20% plus per annum. We expect rupee to remain stable. So when a foreigner is looking at India, he is looking at potential 20% dollar earnings growth in the Indian markets. That is unheard of in any other global markets and emerging markets. And I'm not even talking about the digital economy here, which is seeing billions of dollars of inflows month after month because of the exciting prospects that the Indian market of 1.3 billion plus population offers, and the problems that the global investors have faced in the Chinese markets. And I have many more factors that I have highlighted in the article. I strongly recommend you to read the article.
I have posted the article on the comment section. So what Navin will do is, on the interest of time, we will move to the presentation that you have for us today. But I'm going to come back to this question in the form of what could be, what should investors be cautious of? So we'll come back to that later. But for now, let's begin with the presentation, ladies and gentlemen. Yeah. So Navin, over to you.
Yeah. So as you know, Mr. Ramdev Agarwal, who's the co-founder of the Motilal Oswal Group, has a deep passion for equity research. And unlike many other CIOs or founders, he has been without a break since the year 1995, been authoring a study called Wealth Creation Study. All of those studies you can Google are available, all 25 studies, and his speeches and all his articles are available on a website specifically meant to store all literature relating to the wealth creation studies. So he has been doing these studies non-stop from 1995 to 2020. In fact, last year marked the Silver Jubilee 25th study that he did. And on that occasion, we released a book, which I would strongly recommend you to consider reading, titled Secrets of Wealth Creation. It's available on Amazon, it's available on Flipkart, and that has a treasure of all the 25 frameworks that Ramdev Agarwal has collected, has deciphered, has analyzed, and has brought to practicing in India investing over the last 25 years. So all of that is available to you in that book, which I would strongly recommend you to read. 15 years back, he wrote a study called Next Trillion Dollar Opportunity, right? And I'll run you through what the study really means. But really, this is a very powerful investment framework that we put to work. Basically, we believe that the linear GDP growth of the Indian economy is likely to present non-linear, i.e. exponential opportunities for businesses to capture profit pools and for investors to benefit from that wealth creation. So here's how it looks like. So India took 58 years post-independence from 1947 to touch the first $1 trillion GDP. And every subsequent $1 trillion of GDP, in our view, as per the study which we authored 15 years back, was to happen faster. Now, what has transpired between 2007 and 2021, over the course of the last 14 years, that $1 trillion GDP has now become $3 trillion GDP, right? So we used to have less than $1,000 per capita income in 2007 because our population was more than 1.2 billion. Our GDP was $1 trillion. So we were at roughly $800 of GDP, right? And today, as I speak to you, we are at $3 trillion of GDP, which is more than $2,000 of per capita income. So per capita income is more than doubled. And we expect that this GDP should cross $6 trillion in a space of less than 9 to 10 years' time. So if we are at $6 trillion GDP and 1.5 billion population, we're really talking about a $4,000 per capita. So $800 per capita may become almost like $4,000 per capita before the turn of this decade or before 2030. Now, you see this chart on the left, the bar on the left side, a bulk of the incomes of Indian households will be spent in basic spends, roti, kapra or makan. So basically, and now mobile is a basic spend also. Expenditure on telecom or mobility probably comes here as well. So bulk of the spends were on basic needs of a household, which we believe cannot grow exponentially as the incomes grow. So $800 going to $4,000, $1,000 going to $3,000 may lead to a marginal increase in the basic spends, but you're likely to see an exponential growth in discretionary spends. The study expects that $100 discretionary spend could go up to more than $1,000, which is a 10x in discretionary spends, and savings can go up from $300 to $1,200, which is a 4x. And this 10x in discretionary spends and 4x in savings and investment can produce many non-linear or exponential opportunities for investing in the stock markets. And this includes consumer durables like Eicher Motors, autos like Maruti, travel companies, entertainment companies, premium wear like Page Industries, uh, a lot of savings plays, for instance, asset managers, wealth management companies, exchanges, depository participants, registrar and transferors, and a whole bunch of these plays potentially on the savings. So we believe that this linearity in the economic growth and the exponentiality in profit pools of discretionary spends and savings pools is what we wish to capture in the stock market. So that is really the whole genesis thesis of the study, which we plan to put to work, through this fund that we launched called the Next Trillion Dollar Opportunity. This fund over the course of the last decade has compounded at over 20%, right? And during this period, the benchmark returns have been more like 11%. So it has basically multiplied 8.5x, while the benchmark is multiplied 4.5x. So it has generated twice as much return, or nearly 4x extra compared to your original cost compared to the benchmark itself, after all fees paid by the investors. In terms of returns, this has given a compounded 16% return compared to the benchmark return of 11%, or an outperformance of 5% per annum. Now, all this has been made possible because of a whole bunch of multi-baggers that the fund has successfully invested over a period of time. So we have had a whole bunch of these multi-baggers, from Eicher Motors to GlaxoSmithKline Consumer to Bajaj Finance to Ipca Laboratories to Voltas. But these are some of the old winners. More recently, we had bet on Max Financial Services, which is already 3.5x multiple of cost. We invested in Gland Pharma 10 months ago in November of 2020 on the day of the listing, and that's already 2.3x of the cost. We invested in ICICI Bank, which is already 2x of the cost. So, basically aligning ourselves with multi-baggers and holding them through the life of the fund has been really the big driver of this extra return or excess performance of the fund over a long period of 14 years. And we believe that many of the recent purchases offer similar multi-bagging opportunities for the investor. Now, point-to-point returns may be very hazardous. So what we try and do is understand what are the 5-year rolling returns of the fund. And if you look at the history since inception, since day one of the fund till date, the fund has generated more than 15% return for 75% of the times. In comparison, the benchmark has generated more than 15% return 30% of the times. So it's 2.5 times as good as the benchmark. And if you look at the average 5-year rolling return through the life, irrespective of when you entered, the average rolling return has been 21% versus 11% for the benchmark. Once again, twice as good as the benchmark. Courtesy the QGLP investment philosophy, courtesy the NTDOP investment framework, courtesy the buy and hold thought process, courtesy the multi-baggers that I showed to you. Now, we believe that we are at a very interesting point in time in the economic cycle. As I talked about earlier, we believe that 2020 to 2026 resembles to us like 2002 to 2008. That was a time period when we saw corporate profit to GDP go up. That was a time period when we saw overall growth, strong earnings growth of 25%. That is a time when we saw strong re-rating of almost 10% per annum. And that is a time when we also saw stronger performance of small and mid caps. And this fund has half of its total assets allocated to small and mid caps, and the other half to large caps, right? And it is reasonably well diversified across sectors. I'm going to run you through that in a separate slide. But more importantly, if you look at our QGLP framework, Q is represented by the return on equity of the company, and the portfolio offers a 20% future return on equity. G is represented by the earnings growth, and the likely earnings growth of the portfolio is 24% per annum over the next 3 years, based on the analyst estimates and the consensus estimates. And 24% growth in profits over the next 3 years implies that the profits can double in the next 3 years' time. Longevity of this growth, these companies, is very high in our view, and the portfolio trades at 1.2 times PEG. This is our favorite valuation metric. We look at the trailing PE of my portfolio divided by the next 3 years earnings growth, which is a PEG of 1.2, which is the most attractive PEG that this portfolio has traded at over its 14-year history. So please remember 3 numbers that I spoke about. One is the return on equity, which is a representation of quality. The second is 24% earnings growth next 3 years, which is a representation of G or growth, and 1.2 times PEG, which is a representation of price, reasonable price. Now, when I compare this to the BSE 500 index versus the 20% return on equity, the return on equity of BSE 500 is 13%. So NTDOP portfolio is far superior, 1.5 times as good as the return on equity of the benchmark. If you look at the EPS growth, the EPS growth of NTDOP is 24%, better than the 21% earnings growth of BSE 500. And by the way, the BSE 500 earnings growth includes the humongous growth from loss to profit for loss-making companies, the humongous growth in the metals companies and material companies, and so on. Even without owning those names, we have a reasonably strong and a superior earnings growth of 24%. But more importantly, for superior ROE and a superior EPS growth, you are paying a lower PEG of 1.2 times compared to 1.6 times for the benchmark. So on all the 3 parameters, we consider this as the golden triangle of investing, which is quality superior than the benchmark, return on equity, growth superior than the benchmark, which is the next 3 years earnings growth, and valuation superior than the benchmark, which is the PEG ratio. One of the unique things about this portfolio, because of its fundamental construct of being leveraged to discretionary spends and savings, because of its construct of a 50% small and mid cap exposure, we've seen the fund really do exceedingly well after every crisis. So post global financial crisis, the fund delivered 117% return in a single year, which was a 27% outperformance versus the benchmark. Post the Asian currency crisis, in 2 years' time, the fund gave a more than 135% return and hugely outperformed the benchmark. So 117% return, or more than doubling of the NAV in a single year's time, more than doubling of the NAV in 2 years' time. And this time around, as I showed you, with a PEG of 1.2 and a compounded earnings growth, which is likely to double in the next 3 years' time. I leave it to your guess. But if the PEG does not get re-rated, then at least the earnings itself are likely to double in the next 3 years' time. If the PEG gets re-rated, like we saw in the 2002 to 2008 cycle for the markets, then the benefit to investors could be even better than the earnings growth. So this is an important construct in my view. In terms of how the portfolio is positioned, we believe that we have some of the best names like Kotak Bank, which we believe can grow very strongly whenever there's an economic recovery, and they are very overcapitalized. They have all the subsidiaries owned 100% by them. Those subsidiaries can grow even faster than the core bank. ICICI Bank, where we are very positive because of the change in the leadership, where we expect very strong growth of almost 30% per annum in the next 3 years in their earnings year after year, taking the return on equity up to almost 15-16%. And they have subsidiaries like their general insurance company, Lombard Life Insurance Company, their asset management company, their securities company. All of them are doing very well. And this bank is basically over-invested or early invested in digital business compared to some of the other private banks, and should leverage the benefit of that. We have held Voltas from a stage where they had a 10 to 15% market share. Today, it's a 25% market share company in air conditioner business. And they've now launched through a European joint venture, refrigerators, washing machines, dishwashers, and ovens. Addressable market has gone up. under penetration of ACs is huge, where India's consumption of air conditioning, despite a hotter climate than China, is at 1/15th their level. And with work from home, rising discretionary spends, as I showed you, as per the NTDOP study, we expect continued strong growth in this business and potential for this company to take its market share up from the current 25% to much higher. In fact, the CEO of the company comes from Hindustan Unilever, where he has routinely seen 50% market share in many of their categories. Page Industries is another leading player in the undergarment segment, and we expect this discretionary spend line item to also grow strongly. L&T Technologies as a company was bought by the fund literally immediately on the listing of the IPO about 3.5, 4 years back. The stock's already up 5 times and is now among the top 3 holdings in the portfolio, mainly by virtue of appreciation. This is an ER&D company. ER&D space is likely to grow faster than the overall IT services space. We believe that because of the COVID pandemic, there was a weak FY21 for ER&D companies in general and L&T in particular, but we expect industry beating very strong comeback in earnings growth in the year ending March 22 and 23. Tech Mahindra is going to be a beneficiary of huge 5G rollouts globally, and this is a leading player in this space. TCS needs no introduction, all of you are aware. L&T Infotech was another company that was bought very early on. Both of these companies from the L&T group had little respect when they got listed, and today have been one of the best performing companies within the technology space. Autos are impacted because of COVID, and we expect strong turnaround in these companies whenever the third wave is behind or if there was no third wave. Again, Gland Pharma I've already spoken about. We had bought this in November of last year on the first day of the listing. This is India's largest B2B injectables player, exporting to the US. And now they're looking at entering the Chinese market by leveraging the distribution network of their parent, Fosun, by leveraging the US FDA filings to ensure accelerated approvals in the Chinese markets. Chinese market population is 4x of America, and their injectables consumption in dollar value is the same as America. And Gland Pharma has all the credentials to redouble its success of US in China once again. Aside of this, they have a 250 million COVID vaccine order from Sputnik that they start supplying from the next quarter, and a lot of cash on the balance sheet, which they will leverage to acquire companies where they have technology gaps, but they can leverage their large customer base as well as their manufacturing prowess. Insurance, we are very positive on the long-term prospects or the decadal prospects of value migrating from state-owned insurance companies to private sector insurance companies. Axis Bank is the only leading private bank which does not have its own insurance companies. HDFC, SBI, Kotak, ICICI, all of them have their own insurance companies. Now, Axis has bought a large stake of 18% and a board seat on Max, and we believe that that will drive a stronger growth in the top line and the market share of Max Financial Services. They have among the best-in-class ratios, whether it's the NBP margin, the ROEV, which are metrics that are used in the insurance sector, but trade at less than half the valuation of the bellwether HDFC Life Insurance. The stocks are already done 3.5x from the cost price of this fund, but we see the runway to be continuing to be very strong. Aside of this, we have a whole bunch of other plays which can benefit from the recovery in the economy, from the cement sector, from the engineering sector, which are best in class. So that's a little bit that I wanted to present to you. We believe that the linear growth in GDP can present exponential opportunities. Discretionary spends and savings will be the way to play this. That's exactly what this fund has done, and that is why it has generated strong performance over long periods of time. So I'll pause here, and I'm happy to take any questions that you have. But in the meantime, I think Sankalp had a few more questions left, and we can go to that before we move on to the next section of this presentation. Thank you, Sankalp. Sankalp, I'm not able to hear you. Are you on mute?
Yeah. So are you on mute is one of the most heard phrases, I think, of the times.
Yeah.
Thank you so much for the presentation, Navin. It's been very interesting, actually, a lot of insights. We've all been looking at NTDOP very closely and very dearly. A lot of investors personally associated with us are NTDOP investors. So that was just some very good insight. And okay, so why I wanted to introduce the topic of today's discussion a little bit later after we had heard your presentation and your discussion about your notes. So the topic of the presentation today, or the webinar today, is the next decade presents a stupendous opportunity to create wealth. But okay, but what happens is that investors, I feel, are a kind of species of who are worried at market tops, who are worried at market bottoms. Okay, so the concern is really high here at 70,000 Nifty, Sensex close to 60,000, and we began with the poll. What happens if the market crashes 25-30% in the next few months? How, as investors, okay, so we know numbers, we know how market crashes are, how brutal they can be, but yet good companies do come back. Okay, but what is your advice to an investor? Because ultimately, at the end of the day, it is very essential to stay invested, or it is essential to participate to make these kind of returns. Okay, so what is your advice to investors who are right now thinking that we are at market tops, let's wait, or who are already invested fully and are looking at the market and thinking ये तो बहुत ज़्यादा आगे चला गया. So what's your take on what's your advice to them?
This is a great question, Sankalp. In fact, last 3 months, everybody that I've been meeting, my friends, my family, my distributor partners, my investors, they've all been asking me this question because they've seen a low of 7,000 odd in Nifty, and now they're seeing a high of 17,000 in Nifty, all in a space of maybe 16, 18 months time, right? And so they're very right in being bothered about the markets, because the previous decade for the markets have been quite abysmal. Now my view on this is, in fact, just yesterday I wrote an article just exactly answering this, where I talk about are you worried about the rise in the markets, right? And I end with a question mark, because that's really the question in the minds of everybody's all the investors. Now what I've again tried to do is I gave you this parallel of 2002 to 2008. I'm just going to use that template at that example once again. So let me remind you that Nifty was about 1,000 points in Jan 2002. Okay, and in a space of 6 years, it went up to 6,000 in Jan 2008. So Nifty went up by 6 times in 6 years, which is a compounded return of 33% per annum. Correct? I just spoke about how earnings growth plus re-rating was the gift that they got, right? But who benefited from that 6x? This was a dumb Nifty return, right? Index return. Active managers like us gave you 8 to 10x back then. So who benefited from that 8 to 10x? Not everybody. Very few. Who were the ones? So it is very important to understand who won that battle last time, so that we can win this battle this time around. So between Jan 2002 and Jan 2008, there were 7 double-digit corrections. More than 10% or 10% corrections happened 7 times. And in fact, 2 of those corrections were of the order of 30%. Now, if you do a poll very quickly and ask people, do you remember what were the reasons for those corrections? Very few people will remember. But today, the common question is, will taper tantrum in the US drive a 20% correction in the market? My answer to them is, taper tantrum can drive a correction. Global logistics can drive a correction. Some policy change like demonetization can drive a correction. Next 5 years, there will be a central election that can drive a correction, right? Lots of things can drive a correction and will drive a correction. And there would be many things that you and I don't know, which can also drive a correction. There will be maybe 5, maybe 6, maybe 7 double-digit corrections, maybe a few 20 to 30% corrections this time as well. So I was talking about who won last time, who made that 8 to 10x last time. Those who followed buy right, sit tight. Those who sat through those corrections. If you try to buy high and sell low, what will end up happening is exactly the reverse. You will end up doing exactly the reverse. And I've shown in my article that there's a big difference between investor return realized and investment return offered. Correct? So basically, by doing this in and out of the market, sometimes investor feel that I have received, मुझे तो equity से सिर्फ 8% return मिला है, which is lower than the return that you would get in that thing or this thing. The issue is that temperament is 99%, IQ is 1% in investing. And what is temperament? To be greedy when others are fearful, right? Or to display patience. And what is patience? Patience is not to hold on to stocks or the markets when they're going up. Patience is to be accepting these drawdowns of 10, 15, 20% on a recurring regular basis. Like a 7 times double digit correction in 6 years is what you have to take in your stride if you really have to multiply your money 8 to 10x. Let me leave you with one last statistic that I've again quoted in the article, which is that in the last 20 years, Nifty has seen a double digit correction in 18 years out of those 20 years. And in 9 out of those 20 years, the correction has been more than 20%. But what has been the outcome? So Nifty has been a very choppy place. 18 double digit corrections in 20 years and 9 20% plus corrections in 20 years. Very, very, very choppy, very pothole driven journey. But this journey has produced an outcome of 17 times Nifty multiplication from 1,000 to 17,000 and a compounded return of more than 15%. I'm talking about passive market returns. I'm not even talking about active managers like us, which I showed you delivered 5% excess return through the life of NTDOP. So that's really the experience. And if you can overcome your temperament or emotion, if you can get a good night's sleep when your portfolio is down 20%, then you won the battle of equities in my view.
That's very profound, and I hope most investors don't have to go to that extent. But we'll move on to questions. We have a lot of them. Okay, so obviously, today if you do a webinar with someone as learned about the stock markets as you, we have to expect a question on valuations. Okay, so Mr. Amit Khator sent us this question on chat about what's your view on valuation now, because QGLP has an element of price. And I remember in one of our earlier webinars, you said that as a house, you're a little bit more conscious about price now. Okay, so we're trading at lifetime highs. Mr. Amit gives us the example of 1.4 times to GDP. The market cap to GDP ratio is more than 1.4 times now. So what is your view on valuations here? And how do you look at valuations in general, Navin?
Yeah. So, usually valuations has to be done at a company by company level. When you aggregate everything, i.e. you aggregate a steel company, you aggregate a loss-making company and a profitable company, a consumer company, an IT company, then the outcome is something that you cannot understand as an animal. You don't know what that animal is. But I want to give you 2-3 perspectives to think about valuations. Firstly, what is valuation? Let's say PE means, let's say market cap divided by profits. As I mentioned to you, corporate profits are at a 2-decade low as a proportion of GDP. They are at 2.1% in the year ending March 2021. So if your denominator is deflated, let's say your average is 4.5 or 5%. So if you multiply your corporate profit that you're using in your PE ratio by 2.5, then your PE will come down by 2.5 times. Correct? In other words, if you look at the corporate profit pools, telecom sector is making a loss, commodity sector did very badly, capital goods companies did very badly, auto companies did very badly, PSU banks reported losses. There are pharma companies because of US FDA issues did badly. So many corporate profit pools have got depressed or destroyed that when you look at the aggregate market PE, then it will look very inflated. On the other hand, if you look at the representation of businesses in the listed space, you are seeing a lot of new, exciting, interesting listings that will anyways take your market cap to GDP up. Also bear in mind that there were certain conventional wisdoms about what should be the market cap to GDP. And US, because of its companies becoming more and more global, right, have seen their market cap to GDP continuously go up and now well over 200%. correct? Indian IT sector is truly global. TCS generates hardly any profits from India. Infosys generates hardly any profits from India. Sun Pharma generates very little profits from India. So basically, today you are dividing, the denominator is the GDP of India, while the numerator has companies which are becoming more and more global in nature. So I believe that this ratio may not be very reflective of the potential. We believe that stocks are slaves of earnings, strong earnings growth, newer listings, newer business opportunities provide a lot of exciting runway for building a nice concentrated 2025 stock portfolio from which you can generate a 20% profit growth, which has an ROE of 20%, which has a reasonable modest PEG of 1.2 times, as I showed you for the NTDOP portfolio itself.
Right, right. So that's very interesting perspective. You should look at valuation in a very absolute company basis. Thank you for that question. So, we've got Mr. Puneet telling us that he has personally gotten a 20% CAGR on NTDOP. So, congrats on that, Navin. So, we've also got a few questions on concerns of performance, which we will limit to the later part of the presentation of the call today. So, I have this question for you, Navin. Like in our discussion today, we have gone back to history, and we've realized that a lot of similarities are carried forward into bull runs or bear corrections, in either way. So a striking feature of the previous bull run between 4 to 2008 was that there was a lot of capacity expansion. Okay, our capacity utilization had gone ahead, and a lot of investors have been asking this to us as well, and I'm sure you would have also gotten this. Do you think that there's a dearth of greenfield expansions in the country, or the capacity utilization is in general a lot lower than what it requires during a boom or expansionary phase? And if this is missing, if this capacity expansion is missing, what do you think will substitute it to keep the bull run fueling?
That's a very good question, Sankalp. So once again, I am a strong believer in data, and I've cited 6 points in my article about what are the signals available for the Capex cycle, right? So if you look at the core sectors of India, the capital expenditure in the core sectors of India was 2.5 lakh crores in the last 3 years. And based on the announced projects, that number is 5 lakh crores, or 2 times in the next 3 years' time. Point number 2, I believe that production linked incentive or PLI is one of the most interesting government programs which will actually drive a revival in India's manufacturing, India's competitiveness for manufacturing sector, and drive down imports and drive up exports. Correct? Collectively, based on announcements already made, the expected capital expenditure will be 1.5 lakh crores on this account. This was zero in the last 3 years' time. Right? Third, biggest capex of households in India happen in real estate. And as you know, India had a lost decade as far as the real estate space is concerned.
Absolutely.
We believe that with RERA in place, with much better, you're aware of all these REITs that are now available, right? A lot of foreign money available. We believe that the next decade should see huge investments in the real estate space. So the household capex should go up. Third, if you look at the government capex announced in the year ending March 2021, despite the COVID pandemic, was up 31%. And you must have already seen the budget for FY22. The expected government capital expenditure is a growth of 26%. Fifth, if you look at the government directive to PSUs, they're asking them to fast track or upfront all of their capital expenditure. So if you sum all this up, I think we have all the signs of a very strong capex cycle that could be ahead of us. Unlike the last decade, where we had falling capital expenditure by private sector, no such interesting government programs, and government itself slowing down as far as own capital expenditure is concerned. So the future, the next decade is likely to be, I think, absolutely the opposite of what you saw in the last decade.
Right. I think Mr. Girish asks a very important follow-up question to this. He says, are Indian banks strong enough to drive the Indian growth? I think what he means is, who will fund this capex?
Yeah. So what is happening is that a lot of our green capex will come from green bonds for which there's firstly remember that uh, there is an abundance of capital globally and returns are
Absolutely, yeah.
falling, and there are not so many attractive projects available, and India offers phenomenal opportunities. You see, all ports are funded, all airports are funded, right? DFCE is funded. So basically, we are likely to see strong global funding that is likely to be available. We're likely to have green bonds that are likely to be available. We will have the bond market which will support it. We will have InvITs that will support it. We'll have REITs that will support it. And more importantly, India's inclusion in bond indices can open a completely new chapter. As per one of the reports that I was looking at, there's likely to be $200 billion of funding available just because of inclusion in one of the bond indices, not even the primary bond index. So I think the runway for low cost, cheap global capital being available to Indian investments is likely to be a reality for the next decade. So funding will not be a constraint for good projects, in my view.
Right, right. That's a very interesting perspective. And Naveen, I must, appreciate the kind of knowledge that you're bringing to our platform today. Thank you for that. But we will, we will do praises after we're done with the session today. Naveen, I'm going to call you. But we'll take a question from Mr. Rajneesh Mehan, and he's asked a very important questions. So Motilal has been known to play the value migration theme. We've done it with, PSUs to private banks. Okay, and the question that he asks is that now now a lot of like fintech is something which we hear every day now. Okay, there is a fintech. Fintech. I mean, there are 27 unicorns. A lot of them have leveraged fintech kind of solutions. Okay, so do you think that a large portion of all fund managers, active fund managers today, are in the BFSI space? Okay, so do you think that there's again a beautiful play waiting to happen, in this particular space?
Absolutely, we believe that technology is becoming more and more core to businesses. It is more true for services as of today. So whether it is fintech, whether it is delivery, food delivery, whether it is beauty, whether it is health tech, whether it is payments, I think every part of the business, India is offering some of the very interesting opportunities. What was happening earlier, Sankalp, is that a lot of the opportunities were being captured by the global players alone. So an
Right.
Amazon, right,
Or Netflix probably.
or a Netflix, or a WhatsApp, Google, Facebook. But now we have Zomato, which is an Indian company promoted by an Indian, or a Swiggy. We have Nika, which is a local play available. We have Flipkart, which may be listed locally now. So I think you will have a whole bunch of very attractive, very interesting, new age business models, which can potentially grow exponentially in the next decade. So we really believe that digital business is something that whether one decides to invest or not is secondary, but one should have an open mind to not get outdated. At least look at them, try to understand them, give them enough time, and wherever you think that there is a strong, sustainable, competitive advantage or a customer proposition that a technology company is bringing to the table, I think those will then form a part of the core holdings of any quality portfolio.
Right, right. So I will ask a follow-up question to that. I mean, how do you view these new age companies that are now slowly, I mean, that have taken the leap of hitting exchanges in India right now? With Zomato, one of the most talked about IPOs. I think Policy Bazaar, Nykaa, all of these guys are also coming soon to the exchanges. How do you view them from the QGLP lens? Okay, considering that a lot of them struggle to make profits, or are just take are guzzling cash. So how do you essentially look at from your as Motilal Oswal Asset Management as a house, and do you think we will see any of these in your portfolios anytime soon?
So basically, there are a lot of interesting books which explain you, and there's Ashwath Damodaran's blogs that people can read. There's End of Accounting book and many other interesting books that people can read. See, historically, businesses incurred a lot of cash expenditure on capital expenditure, right? Now, all of that is running through your P&L. So when a large investment is made by a cement company, and when they're setting up, 1,000 crores of cement facilities, all of that gets capitalized, and maybe 5% of that gets charged to the P&L, right? So profits look very robust. If, on the other hand, another player makes acquires 2 million customers and incurs a 2,500 crore capital expenditure in a year, which is run through the P&L, it will look like a massively loss-making company. Both of them are investments in the future that will give you rewards in the future. In
Right.
one, you're taking it to the balance sheet. In the other, you're running it to the P&L. So really, one has to be very careful about how you do the accounting for some of these companies. But fundamental principles remain the same. Do we believe that that company has a sustainable competitive advantage? Are there moats, and is it difficult to enter that business, right? Is that advantage likely to sustain over long periods of time? Do they own that customer? They may be burning cash today, they may be reporting a loss today, but do they have a high gross margin that is sustainable? Do they have customer acquisition cost that will go on falling because of the platform effect, because of the network effect, because of which you can see humongous cash flows over a period of time? See, we have seen in the West that when some of the companies like Facebook, etc., had profits of 30, 40 million dollars, people thought that they were ridiculously expensive, they're crazy, they don't make any sense to a quality investor. And today, when they make a $50 billion profit, they look like a 25 PE company after having been a thousand bagger already.
Right.
So I think it depends on whether you understand that business, whether that you believe that business has a moat or an advantage that can sustain, and whether the future cash flows discounted today still make sense to you. And we believe that there will be interesting opportunities. And as I speak to you, we already have invested in some such companies in our portfolio. They're already there in our portfolio.
Right, right, right. So thank you for that answer. So now I will come back to what question I began with. Okay. So, when you drive from Bombay to Pune, they always ask you to be cautious around the ghats there. Okay. So as we are going to take a ride through the next couple of $1 trillion in Indian GDP, let's talk about cautions. I mean, what will Navin Agarwal or what will Motilal Oswal Asset Management be a little bit cautious about? Taking cues from history, taking cues from previous bull runs. What is it that in general will make you cautious?
Yeah, so basically, the investment 101 principles are that we should not time the market. I'll be very cautious about that, firstly, because what will happen is that there are times when this whole beat and upgrade of earnings implies that the current earnings may get upgraded in the future. And so looking at high valuations today and quitting a stock or quitting a business, a quality business, or giving it up is something that I will be cautioning the investors on. I mean, just because you saw a mark to market, low point last year, and you are doing much better today, if that is your reason to, exit, I would caution you against that. I mean, I talked to you earlier, before this webinar when we were chatting that most professional investors, water their roses and cut their weeds.
Right.
Most, lay investors end up watering their weeds and cutting their roses. So, they become long-term investors in companies that they're losing money and which are doing badly or which are mistakes. And they end up booking profits frequently in some of their finest or the best performing companies. So that's something that I'd like to really caution you against. The second thing that I'd like to caution is that, small and mid caps is not everybody's game. The mortality of small and mid caps is much higher. Don't drive looking at the rare view returns in some of the companies and some of the segments of the market may look very attractive. Please look at the front screen and drive your car, otherwise you meet with an accident. So I would recommend you to be very careful about the next tip, the next hot stock that your friend is recommending. I would strongly urge you to consider taking the help of professionals to invest in the markets so that you can create wealth over a long period of time. So I think I'm not really worried about the externalities. I would only say that what will really seriously bring down the markets is something that we are not thinking about today on this call. It cannot be something that we are all fearful and worried about. Most likely, most of those things may already be discounted in the stock markets and the stock prices.
Right, but those are very two important points. Your best cautious approach would be to not leave the party early.
Yes,
Right.
yes, that's
So
the biggest mistake. And what happens is that that compounds actually. The
mm,
booking a loss does not increase the loss, but quitting early can compound your mistake. Meaning,
right,
100 rupees that you withdrew from the market may actually be 500 rupees of lost gains. And I think that is what one has to be worried if you really truly believe that we are in a corporate and economic cycle which has a long runway, and you are in the first 25% of this movie.
right, right. So I agree with you there, because what happens in the market, once you miss a stock, you miss it forever. You are unlikely to buy it, once it has rallied 20% more, 30% more, or even 100% more. So it's very important that once you've chosen a good business, a good manager, you stick with them. So, my next question, I will. So around 2001 to, I mean, 99 to 2003, 4, the Indian markets were in bad shape, but so was Indian cricket. And when I look at you, I think of a younger Saurav Ganguly who came and who turned around Indian cricket and then took it to where subsequent captains took it to where today it is. And you at the helm of affairs at Motilal Oswal Asset Management now are often, I'm sure, asked about the slight underperformance in the last couple of years. Okay, so and we've got a lot of questions on the chat also. So I think we should take this opportunity to address those, because these are investors who are invested with you. And what is your advice to them, and how are you looking at getting back, or how are you looking at doing the right things? Because return at the end of the day is a lot market dependent, but choosing right businesses is with us. So over to you.
Absolutely, that's a very valid question, and thank you for the opportunity to answer that question. So basically, one of the things that happened with us was that if you recollect, from a 1,000 crore asset management company, 7 8 years back, in a space of 5 6 years, we went up to 40 45,000 crores of assets. We believed in buy and hold, buy right, sit tight, and concentrated portfolios. So what ended up happening was that we kept on buying more of the same names that we held, and the multiplication in the stocks happened because of strong earnings growth as well as PE re-rating, where at a point in time some of the companies that we held saw P's shoot up to 50 to 100 times because everybody was chasing the same stocks that Motilal Oswal Asset Management was buying, correct? And because of that, the golden triangle, where the return on equity being very high, EPS growth being very high, was met, but the PG also went up very high. So in fact, Ramdevji did a wealth creation study after that, where we brought in the discipline of trimming our winners and cutting our laggards at a periodical interval, such that the portfolio PEG, which I showed you for NTDOP, is 1.2 right now, and which is 1.6 for the benchmark, should never cross 2 times, right? In fact, right now, despite the strong performance of the portfolio in the last 1 year, right, because of the economic tailwinds, the market tailwinds, the PEG today, as I speak to you, is at 1.2 times. So we believe that paying a right price incrementally for all your purchases is very important for future returns. What ended up happening is, for the year ending March 2018 and 17 and 16, those 3 years, you effectively got excess return due to PE re-rating, which robbed off some of the returns from 2019 and 20, which is what is reflected in the relative underperformance. We believe that this discipline of having your PEG of the portfolio at less than 2, for sure, if possible, less than 1.5 times, and as you saw for NTDOP, it is at 1.2 times, will ensure that earnings growth translates into portfolio performance, and there's no detraction due to portfolio derating. So I think this is the change that we've brought about, which is what has seen a comeback in some of our portfolios. And we think that going forward, if you get your earnings growth, that itself should be great. if you get a PE re-rating like we saw in the 2002-2008 cycle, or when you own a portfolio which is at 1.2 PEG compared to a benchmark PG of 1.6 times, then you have that upside potentially of 35% due to re-rating of your PEG also. So this is it's a little technical or a scientific answer where what I'm trying to tell you is that the stocks, I mean, a lot of investors tell me when I look at your portfolio, I find every stock to be fantastic. Then why is it not doing well? And the answer to that is owning great companies is different from owning great stocks. The difference between great companies and great stocks sometimes is the price that you pay. Because of the huge inflows that we got and the prices going up and the PEG going up, future returns got upfronted in the years of March 2015, 16, 17, because of which the next 2 years had a challenge. That correction we've made, and we are very confident that going forward with PEG being under control, the return should be at least equal to the earnings growth of the portfolio.
Right, right. That's a very, very good answer, elaborate answer, and I'm sure a lot of investors on the call would have found that useful. So we'll take last few questions, okay? And interest of time, again, Mahinder Gupta asks a very, very. I mean, I find it interesting. He asks, when do you feel the market will correct as per your experience? So let's take it like when you think you think, like you said, future returns sometimes can get upfronted. Okay, the difference between owning great businesses and great stocks. So, while Indian corporate profits could continue to do well, but markets could be choppy, could be sideways, could take a breather. Do you think any of those are in the cards, could be on the cards in the next, 1 year or so?
Yeah, so I think very hard about this question. Actually, I've already thought about it, and I was trying to think through what are the frameworks to answer this question. So one was, let's say, fundamental framework, that fundamentally when this happens, this PE happens or this happens, the markets will fall, right? But usually markets don't subscribe to that markets will fall from 20p or 25p. But behavioral finance has answers to many of these questions, and many of you may find it funny, but the answer to this question is, when most people stop asking these questions or stop thinking about this, is when the markets will have a nasty correction. As long as we fear this, as long as we ask this, as long as we think this, as long as we dream this, there will be no correction. Today, I see this as such a big question that I have dedicated a whole this monthly newsletter of mine to just this question, to explain to people that the long-term runway is good. But yes, when your guards are low, so I mean, let me draw another parallel. Was anybody in this audience expecting the first wave of COVID? Zero. That's why we had a very nasty correction. Was anybody expecting a second wave? No. That's why we had so many deaths, unfortunately. Is everybody expecting a third wave? Yes. Maybe the third wave will not happen. So it is when you least expect a correction in the markets that a correction happens. If you go back in time, and I don't know whether many people remember this, but in 2006 late, 2007 early, 2007 mid, everybody was pregnant with expectations of corrections. And when everybody loosened their guards in 2008, we had the nasty correction. So really the answer to this question is in behavioral finance. As long as we keep asking this question, rest assured there will not be a correction. The day we loosen our guards and we stop being bothered about this is when you will have a correction.
Right. That's a very interesting answer to this. I hope Mahendra ji आपके सवाल का जवाब आ गया है. So with that, we will take the closing notes from you, Navin. Just any perspective you want to give to our investors with your wealth of experience, your knowledge, and as investors, you are one of the largest investors in the country with Motilal Oswal AMC. Just some wisdom to the investors in general about how they should look, how they should behave, interact with the market. Over to you.
Yeah, so I can just share with you a little personal, wealth creation secret, which is that 30 years back I started earning my first rupee, and now while there are a lot of very complicated, very sophisticated asset allocation tools that are available, I have for the last 30 years been 100% invested in equities every single day, and that has held me in very good stead. I've not tried to time the market. I've not tried to benefit from the highs and lows. I've tried to benefit from the compounding of the markets. I mean, even before I started earning my first rupee, I was looking at the Sensex, which was born in 1979 at 100. And today, that 100 Sensex is already up nearly 600 times, correct? And this is the dumb index. I'm not talking about outperformance. So last 40 years has given you 600 times multiplication of your wealth. Meaning if you just owned a crore rupees of Sensex, that would be worth, 600 crores today. I believe that the next 20 years will not be any different in terms of wealth creation. So if you can buy right and sit tight, right, that will be the best thing that can happen to you. And at Motilal Oswal, we are very different from others because we have 100% skin in the game. All of our wealth is in these funds. And we believe that while we may have year to year of hiccups, longer term, our processes keep improving year after year with every wealth creation study that we've been doing for the last 25 years. And we feel that the future is very exciting. And so we are fully invested in our funds. And that's what we would recommend to you also. Thank you very much for the opportunity.
Right. Thank you, Navin. Thank you to the very, very patient audience for sticking with us. For being with us on this show today. And I wish you all a very happy Ganesh Chaturthi. And this was a Ganesh Chaturthi special episode from PMSAIF World, and we tend to bring you more such intuitive guests, and we will want to bring back Navin again sometime next quarter, maybe, or earlier than that. So thank you, Navin, for being with us. A very interesting session. I learned and enjoyed. A lot of perspective for me as well. Investors, watching this on YouTube, please give a like and subscribe to us so that more people can, get content from us. And thank you. Do book a call with us if you have any other queries, or do keep sending us your questions so that we can get them from Navin or his team answered. Thank you, Navin. We hope to see you soon again. Thank you.
Thank you. All the best.